inflation's a little cooler than a couple of years ago, but it's certainly not back to normal the way we remember it, the good old days. Welcome into the show, Retirement Compass Radio Show with Eli Mardock.
Hello there.
Hello from Stonebridge Wealth Systems. Nice to see you from the Omaha office.
Nice to see you too. Good to be back in the studio.
Yeah, great to see you. Of course, the studio's in Lincoln. I'm glad you came in for it.
Yep. Well, I still live in Lincoln, so it's easy for me. It's a hop, skip, and a jump from my house. But yeah, nice to not have to hit the road this morning. So
yeah. What's the commute time there between Lincoln and Omaha for you?
Gosh, maybe 45 minutes. It's not too bad.
It's not too bad. You can listen to podcasts.
I do. I consider it learning time, so I listen to all kinds of different books and audiobooks, of course. And yeah, it's good. It's good 45 minutes both ways of learning. So yeah, it's good.
I do the same. I listen on the Audible app, and listen to all kinds of books. I used to commute a lot longer than I do now, but I didn't mind the commute for that reason. And it's a decompression time, I'm sure, between family and then business, right?
Yeah, absolutely. I've got 4 kids, and so it's kind of nice to be by myself for 45 minutes without someone asking me for something or anything, and actually just not talking. You do meetings all day, and it's great. I love my work, but it's really nice to decompress and just drive and not have to say anything and just listen. So yeah, it's kind of nice.
Well, here we are, Eli. We're going to talk some more.
Well, perfect. Well, this is always fun. You always make it fun, Jackie.
Oh, so. Thanks. I think all of you, all your Stonebridge companions, you guys are really fun in the broadcast area. So I hope people find information that we impart to them not only helpful financially, but maybe a little giggle or two along the way.
Yeah,
so
let's hope so.
I hope so. So how about this inflation thing? Do you feel like it's back to normal? I use my high voice. I don't know if it is or not.
Especially with Social Security and paycheck and everything, inflation, of course, we're losing spending power. And so I know for a lot of folks, and mine including, everything just seems, for my family as well, I guess what I'm saying, everything seems more expensive. And so the money that you're getting is going less far. You're losing purchasing power. And so that's tough.
And you better do well in the next several years, Eli, because you've got 4 children who are going to be facing a lot of equipment, sports.
Absolutely, yeah. It can be a lot. And, I think there's a lot of families in a similar position as we are, where everything, going out to eat is for one meal is always over $100 easily, almost anywhere we go.
Yikes.
So things are a lot different, and wages haven't necessarily always caught up with that.
But I was thinking that replacing that income gap, and I know this is part of what you discuss with people when they come in to see you, potential clients and your ongoing clients, is let's get a stable income to replace that gosh darn paycheck that we're leaving behind. Because this is really, I think, the thing that comes between happiness and retirement.
Yeah, absolutely. It's really, when you think about income planning, it's probably one of the most, in a way, overlooked areas of financial planning, but it's really foundational. So if you think about your retirement, and to put it in simple terms, if you think about a puzzle piece, right? Or if you're putting together a puzzle, you've got all these various pieces. So income planning is a piece, and your investments are a piece, of course, and your taxes are a piece, and your health care and long-term care, that's a piece, and then also your estate and your legacy plan is another piece. The foundational corner piece, that the first one you want to get on before you can start to put any of those other pieces together and make a picture. And if you imagine that final puzzle being your ideal retirement, so to speak, or what you would envision for your retirement, that foundational piece of that puzzle is income planning. And how do we go when we've spent our entire working lives building towards this, and then suddenly all that income ends? How do we redistribute it to ourselves in a way that's reliable, gives us peace of mind, a steady paycheck still coming in from what we've essentially saved? And so that's income planning in a nutshell. And it can get very complex when you're adding in, well, do I have, what's my withdrawal rate from investments? What's my tax picture if I'm taking, maybe I've got a pension, I've got Social Security, and how do I create the steadiest source of income in the most tax efficient way. So it's something we look at quite a bit.
Sure. And when I'm going to hand out your number here, Eli, 866-295-5146, 866-295-5146, serving all of Nebraska and also, let's see, northern Kansas. You have a TV show in Sioux Falls, right?
Yeah, absolutely. Sioux Falls, Omaha, Lincoln, I think central Nebraska as well. So a lot of different stations. So if there's sports, we get bumped, but usually we're on there.
That's good. I know that's why you buy a lot of radio stations, so make sure that the weekly message gets out there. And also the information is available via, podcast and YouTube form. So anywhere you get your podcast materials, we were just talking about that with Eli on his commute between Lincoln and Omaha, you can get the podcast. It's called The Retirement Compass on podcast, all right? The Retirement Compass on Spotify or Apple. And then if you want to look at us on YouTube and see all the TV and all the radio and all the podcast and all that stuff, it is Stonebridge Wealth Systems. Again, the number 866-295-5146. Now, that's a centralized phone number, so whoever and wherever you would like to be seen at any of the offices, including Omaha, Lincoln, Grand Island. We've got John at Grand Island. We can't ever forget about him. And, of course, the fellas at Kearney, fellas and gals at Kearney, 866-295-5146. There's a lot of benefits that go to the retirement era, I feel like. One of those is I'm getting close to within a few years, and that's Medicare, give me all my Medicare. Because as it is now, I'm purchasing my own medical insurance on the ACA. And this is costly, and it's also volatile, isn't it? Because they haven't decided what's what.
Yeah, it's a tough situation right now if you're sort of trying to bridge the gap between either you've retired or maybe you're working part-time or you got a job that doesn't offer healthcare benefits.
Right.
You have to use the ACA right now. It's pretty tough territory, and you just don't know really what the future looks like there. That's a tough situation. Hopefully, hopefully some of those credits that have expired come back and are able to help folks with that. But
I think, don't you think they need to just decide one way or another? Let's get it through the Senate. And if you're not going to do it, don't. But if you are going to extend it, and I realize that those subsidies cost the government a lot of money.
They do. Yeah.
But they do help a lot of people, pre-retirement age like myself, who, we have contractor pay.
Absolutely. Yeah. I mean, it's a really complex issue. It's costly. Healthcare's, it's been an issue for as long as I can remember, dating back as far as when I first started even paying attention to politics or anything like that. And so, but at the end of the day, I think everyone can agree everyone needs affordable healthcare that's high quality. And so hopefully that's something that we can get through the ACA here.
We'll see, right?
Yeah, absolutely. But, in terms of affordable health care, once you do have, Medicare eligibility, some nice things that happen there. One thing that we notice a lot, and this goes back that same example where, we talk about income planning and how all this stuff, you can't look at it in a silo. You can't look at just your investments alone or just income planning, because almost like a domino set. One move in any area is going to set other dominoes in motion. And that's one of those things, especially when it relates to healthcare, involves IRMAAs, what's called income-related monthly adjustment amounts.
Right.
So it's something where oftentimes when people are planning their retirement and income, they're not accounting for how their income sources might change their Medicare premiums. And so there's different thresholds here where essentially if you were, say, making large withdrawals from an IRA for whatever reason, or maybe your RMDs are starting to hit or required minimum distributions. For most people, it'd be 73 or 75 at this point. All of that can really change not only your tax situation, but it's almost like a shadow tax where your Medicare premiums can go up as well if your income is over certain thresholds. So really encourage people to think about their income planning and how that not only affects their taxes in retirement, but also how it affects their healthcare costs.
Sure. And here's the number so you can get all of these pieces of the puzzle put together, or all the points on the compass. You can see them all. Call Stonebridge 866-295-5146, 866-295-5146.
Is your retirement being eaten up by financial termites like hidden fees, inflation, and avoidable taxes? Call today for a complimentary financial review so we can help you root out these retirement killers.
Hey, welcome back to our show, Retirement Compass Radio Show. And represented for Stonebridge Wealth Systems is Eli Mardock out of the Omaha office. And I'm Jackie Selby, if I never say that often enough. Somebody called and said, "Who is the girl? She never says who she is."
You're just super humble.
Yeah, no, just keep calling me a girl and perceive that I am not actually at my true age. Oh, golly.
Yeah,
do you want to talk to us about what's going on now? The One Big Beautiful Bill Act came into law July, so last summer. Mm-hmm. And there's a lot of provisions and deductions and best strategy for 2026 stuff. Can we talk about these items?
Yeah, absolutely. So there's been a lot of changes in tax law over the 6 years. So you've got Secure Act 1.0, Secure Act 2.0, and then just recently, last July, the One Big Beautiful Bill Act, which really had a lot of changes that affects retirees. One of the biggest ones, of course, is that it just made permanent the Tax Cuts and Jobs Act tax brackets that were brought about in 2017. So those have been made permanent, which is great. So that sort of if you remember, at the end of 2025, those tax cuts were set to expire and go back to the pre-2017 levels. And so that's a nice extension there that helps a lot of people. But case in point, an interesting thing about that is while most brackets were made permanent, actually the 37% bracket was not it will not be adjusted for inflation. And so it's one of those things where—
That's interesting.
Yeah, it reminds me of what happened with Social Security. So if you recall, Social Security wasn't always taxed, but then essentially in the 80s, I think it was Tip O'Neill and Reagan made a deal to create some taxation for Social Security. And then they also did the same thing in the 90s. It was Newt Gingrich and Clinton made a deal to add additional taxation. That was sold to the American public as being something that would never affect— it said, look, it's going to be just the top earners in the country that are ever affected by this. But those they weren't adjusted for inflation. So those numbers have been the same since the 1980s and 90s. Now, how many people have their Social Security taxed up to 85%? Quite a few, right? And so it affects everyone. So it's again, one of those— I call them a hidden tax trap, or a very slow springing tax trap, where eventually over time, more and more people, as inflation and wages rise, will start to enter that 37% tax bracket. So it's just another way that taxes go up, and it's not necessarily a headline event where taxes got raised, but more and more people will eventually start to hit that higher bracket if it remains the same.
Right, exactly. And the problem with what we understood to be the case, I feel, is that the president said, I'm going to help out in this area. And all it really turned into was a deduction bracket, right?
I think the goal originally was to eliminate taxation on Social Security. That's pretty difficult to do on a legislative level.
Right.
A lot of pieces to a lot of complication there. And so, that really turned into just that $6,000 additional deduction if you're 65 plus now. Now, there's income thresholds there that you would phase out at certain levels for married filing jointly, or if you're a single filer. But, an easier way to do what they wanted to do. Of course, it's conveniently timed to— those will phase out by the next election cycle. So it's, they'll of course want you to vote a certain way to extend those. I'm sure that will come up here in the next couple of years. But for the time being, regardless of, I never get political on anything. So I'm squarely independent and in the middle on everything. I like to make fun of both sides, to be honest. So, but that's something where, for the next couple of years, if you're 65 plus and within certain income thresholds, that's a great bonus on top of your standard deduction.
Okay.
So definitely something that affects a lot of our clients if you're within those income thresholds. And another reason, just again, to plan your income sources, if there's a way that you can do that and take advantage of tax savings like that, it can be really helpful and add up over time. In fact, there was just a client we met with the other day in our Omaha office who— with some income planning And through the sources of her income, if we were able to reduce her adjusted gross income, would qualify for, in Nebraska, we have what's called homestead exemption.
Right.
And for her property taxes are about $4,000 a year here in Nebraska. But with certain adjustments, if we could get her under that threshold, she would save she'd qualify for 90 to 100% exemption based on income levels with some income planning, able to save her about $4,000 a year.
Wowie.
Based on that, just her income planning. So those are real tangible things that good planning can, keep more money in your pocket, less going to the IRS or the state.
Sure. I'm glad you said tangible, because some of these concepts, maybe people think that it's just out there and, that it's above my pay grade or whatever, but that is a real tangible adjustment. And of course, taxes is one of the points on the compass. Use this number to reach out to the team at Stonebridge, 866-295-5146. Tim and I talk about that a lot. He'll get going and, he does his whiz-bang thing. He's like a wizard over here, tossing numbers around. And I'm like, it all makes sense. Here's the number, 866-295-5146. But that's all people want to know is the government going to get my money?
Sure. Yeah. I mean, it's never about tax avoidance. That's really important, right? That's illegal.
No.
But tax minimization, I'm sure Tim has mentioned this in past episodes, but Judge Learned Hand, he's a judge from the early 1900s, essentially. And he had a decision, I can't remember the exact case, but essentially his opinion was, on his ruling opinion, was that there is not a patriotic duty to pay more in taxes than your due share, what you're legally entitled to. And that's really what we're trying to do here is say, look, this is what, based on our tax code, this is what you should be paying. But a lot of people end up overpaying simply because they don't have the strategies in place. If you understand the tax code, there's a lot of strategies you can employ.
Mm-hmm. It's right. It's not tax avoidance. And we have to choose our words carefully. You don't want to inflame or upset someone by saying something and then this be misrepresented in,
of course.
At the water cooler, hey, I heard those guys on the radio talking about avoiding the taxes. But it's with careful planning, gosh, you guys can save people an awful lot of money.
Absolutely. Yeah, it's an efficiency thing. And what I really love about that as a financial planner, and I think Tim's very similar, is that something where really through planning, I mean, when you think about the market and investments, no one really knows what's going to happen tomorrow. It's something where, of course, there's analysts and you can read all these different sources and
ad nauseum.
A lot of guys with very fancy degrees with lots of opinions. And the fact is that most of them are wrong. And, most investment advisors or hedge fund managers aren't really able to consistently outperform an unmanaged index in the market. That's just a reality. Those strategies, and I'm sure Tim mentions this a lot, no one has some special silver bullet proprietary product that's going to do way better than everyone else.
Right.
But the things that really matter in financial planning is one, not only, investments really matter. And for us, we focus a lot on retirement, of course, with our retirement compass process by helping people win more by losing less mathematically. That makes a big difference. But the other thing is the things that really matter long term. Of course, investments play into it. It's all important. But it's not just what you're earning, it's what you keep, right? And so it's how much can we save on taxes? Do we have a plan on our health care? Do we have a tax-efficient withdrawal sequence? All these things add up and are the result of good planning and have real tangible results that's predictable versus, we can, invest in the market and it will do what it does. That's sort of more like surfing or riding a wave and how can you do that in the most effective way. But when it comes to other areas of planning, you have a lot more control, which for me as a planner, I find very exciting. And it's a fun thing to show clients. Sure.
I bet you enjoy the strategy of it and making it all work and seeing the weight come off of the client's shoulders, right?
Yeah, absolutely. There's not only problem solving, but oftentimes we'll meet with folks and they think they've got everything set up perfectly. But sometimes problem finding can be very valuable as well. And so, oftentimes there's, for whatever reason, folks just didn't get advice on some of this stuff. And so they had no idea there was a problem there. Right.
And here's the number to reach out to Stonebridge, by the way. Call Eli, It's 866-295-5146, 866-295-5146. And uncovering the little, termites in somebody's portfolio, if you will.
Yeah, absolutely. Sometimes there's little leaks in the bucket that we didn't know
Leaks
were
in the
there.
bucket.
Yeah, absolutely. And that stuff can, over time really make a big difference. And so when you're talking about, say you're 65 and you've got a life expectancy, maybe you're going to live till 95. A lot of, 1 in 3 people will live to 95 now. That's 30 years of strategies that really compound over time. So it's important. I always encourage, I call it the retirement red zone.
Yes.
If you're 55 plus or within 10 years of retirement, really making sure that you've got a plan in place. That planning starts then. We meet with a lot of folks who they're 65, 66, and they say, well, I might retire next year. I should really start thinking about what this looks like. Unfortunately, it's great to start at any time, of course. You need to plan, but ideally you're looking at this stuff well in advance.
Mm-hmm. Because if you do have leaks in the bucket, then you can address those things then.
Absolutely. Yeah.
Before you're going into retirement with a half-baked bucket.
Definitely. And there's stuff that you can, even for folks that are younger, let's say you're, in your 40s or 30s or 50s, how you set up the framework, the infrastructure. And this has a lot to do, this is where investments become a lot more important because it's about accumulation, but also from a tax efficiency standpoint, how we set things up with asset location becomes really, really important. So making sure that we've got our growth oriented, let's just take your typical 60-40 investor, right? 60% equities, 40% bonds. And if we can utilize all tax buckets in the right way, so if we want our growth oriented assets, if we can point those in the right direction, let's say a Roth account where all the growth, we sort of pay tax on the seed and then we never pay tax on the harvest. It's all tax exempt growth. That means later we won't have required minimum distributions on that. All our growth is tax-free. And then eventually from an estate planning standpoint, it's tax-free to our beneficiaries. If we can focus growth in the right bucket, that bucket and our more conservative fixed income bonds in the least tax-efficient bucket, which would be tax-deferred, long-term, even that can create mathematically just an incredible amount of savings. I don't want to quote numbers here, but I've seen an incredible amount build up over time in savings just by how we invest our assets, not the allocation or the individual investments themselves, but just having the right type of investment in the right tax bucket. So growth oriented in that Roth and more conservative assets in that tax deferred bucket.
Now use this number before we skip off into another segment, 866-295-5146, 866-295-5146 on Retirement Compass Radio Show.
As Americans, we strive for better. From a better house to a better career to a better life for our children and grandchildren. Better has become the American way. When it comes to your retirement, what does better mean to you? Does it mean more income, a flexible lifestyle, better solutions? A better retirement begins with a financial plan. To get your complimentary written financial plan, call the number you see here. You only retire once. This is your opportunity to plan for better.
Starting a business in retirement or pre-retirement. Why not? Hey, welcome back to Retirement Compass Radio Show with Stonebridge Wealth Systems. This is really a fun idea, especially if you want to overlap it from your pre-retirement years, your retirement red zone, on through the day that you say goodbye to corporate America or whatever it is that you're doing at this time. I mean, this will be fun to build a bridge, right, Eli?
Yeah, absolutely.
I was thinking that having a business in retirement, there's a lot of advantages to this. Anybody who's ever played Monopoly, you know the difference between, being stuck on somebody's property that has hotels on it. That was always my brother, and it made me tip the game over and run away screaming. Retirement entrepreneurship could be a blessing, though, because the tax rules rewards are pretty cool. So I'm just going to go through a list of these, Eli, and see how you feel about them.
Sure, of course.
Self-employment income. This can raise your Medicare premium. True, false? How do you feel about this?
Yeah, absolutely. So, a lot of folks as they enter retirement will have that one kind of thing they always wanted to do, and maybe they start a little side hustle around it. And that's
Right.
great, but increasing your income could, and we mentioned earlier in the show, trigger those IRMAA or income-related monthly adjustment amounts, IRMAA, just based on a 2-year look back. And that's a really key point in terms of Medicare premiums. It's means-based. It didn't always used to be this way.
All right.
But the more money you're making in retirement, essentially your modified adjusted gross income, the more you're going to pay for Medicare if you're over certain thresholds. And so,
that's true.
That side hustle, the thing you've always wanted to do, if you really love it, if you're extremely successful at it, you might notice that your Medicare premiums go up. That's not to dissuade you from doing the stuff.
Sure.
But having a plan around what that is and how it might affect your Medicare, really important.
Sure. And Mike, I just want to throw in a story here real quick. This is Retirement Compass Radio Show, 866-295-5146. Call a member of the team, 866-295-5146. On YouTube, Stonebridge Wealth Systems. My sister did a smart thing a couple of years before she retired. She started a business, she and her husband, a pool cleaning business. And of course, there's a lot of costs associated with the fire up of this thing, right? You got chemicals, you got a truck, you got equipment, marketing, all that stuff. So this was an advantage to their tax claiming because they had a lot of deductions in those couple of years before retirement. So I know the Stonebridge can iron all this out for you, but I'm just trying to present some, good side about that instead of just the negative. Oh, they're going to look back. Conversely, I have a friend in that same age group. She's a little bit older than me, and they did not do anything. They're just taking their income from the Social Security and he has a military and also a pension from the post office. And here she is paying a large amount for her Medicare because of their dual claiming status.
Yeah, absolutely. We've encountered folks who have gotten into, let's say, where they're very successful and they're working and they get into retirement and they want to avoid some taxes. They'll start a restaurant or something that's an absolute money pit for them and write off a bunch here. Whether that adds complication to things or makes things simpler, depends on the individual, of course. But absolutely, there are, anytime you're doing a startup like that or you're having a side business, making sure that you are keeping track of your expenses.
Oh, sure.
Absolutely crucial because, otherwise you're leaving money on the table. That's stuff that you can definitely write off.
Sure. It's fun. I don't know if people are as enthusiastic as I am about these opportunities, but I was thinking of getting a cart. Oh, somebody's going to steal my idea now, Eli.
You better stop here. No.
A nifty cart that you go to businesses and you'll have like snacks and stuff for sale on the cart, but your main business is cleaning glasses. You go up and down the aisle, or you ask the people to put out an email. Hey, that glasses lady is in the lobby, and watch people pour down the elevator out the front to wherever you are to get their glasses professionally cleaned. That's
not a bad idea because, as a glasses wearer, I definitely know that at the end of the day or any time during the day, it's a struggle, and I really hate dirty glasses. Oh, it drives me nuts.
Me too. What is worse? And I get them, the eyelashes hit them, and anyway. Yeah. And then, of course, it's a cute little break for the employees to come down and grab some peanuts or something fun.
Yeah, absolutely.
Nobody steal my idea. What would we call it?
I don't know. The glasses lady or something. I don't know. But it's a weird reminder, I think, with glasses that your face is. Maybe this is gross. It's like constantly spewing out oil and grossness all day, and it gets on your glasses. So it's just kind of gross. Especially in the summertime, boy. Yes. Especially if you're out in the field or whatever. Hey, that's it. I need to go out from farm to farm and clean everyone's glasses. Yeah, but there is something really nice about extremely clean glasses.
Oh yes.
So, that's
wonderful.
Kind of cool.
Yeah. How about our business structure, tax efficient or just convenient? Do you think that a sole proposition is simple? I mean, what for some retirees, do you do an S corp? What do you do? You could, if it's you and your husband, right? One of you could pay the other one, and you could have payroll deductions.
Sure. Yeah. It depends, and oftentimes. It's great to talk to an attorney or your CPA about business structure, but I can tell you that for a lot of clients that I have, they do choose to use an S corp election, which can provide some nice benefits, or even an LLC. First off, with a structure like that, you are creating a nice legal separation between yourself and anything that happens in the business. So that's good. Where if anything happened, they couldn't come after your assets personally. So that's a good deal. Though you have to be very careful about that. You want to make sure you're not commingling funds. You're keeping that sort of separation between your personal finances and the corporation very clean and separate. But then the other thing with an S corp, you can reduce your exposure to payroll tax, essentially, right? And so by paying yourself a certain amount, and the IRS deems it a reasonable amount, but oftentimes we'll see 40 to 50%, let's say, of what's coming in terms of gross income, you're paying yourself as a salary. And then anything above that, and that would be, you would have, of course, you'd have to pay payroll taxes on that. But then above that, everything else that you would pay yourself essentially comes as a distribution from the S corp. And so that's something where you can save a little bit on taxes there from the structure of that. But something where great to have a conversation, with an advisor about that. We can definitely give you our financial planning standpoint, but also a great example of how oftentimes with this stuff, everyone's looking at this stuff, like I said before, in silos. And so you might talk to an attorney about it, or you might talk to a CPA about it. But again, they're looking at it from one standpoint. What oftentimes, at least in my experience, people lack is someone who's really looking at everything and coordinating with an attorney, coordinating with the CPA, and then also with your entire financial picture to make sure that it's really everything is working in concert together. And that's really important.
Sure.
And I kind of compare it to like a family physician of finances, where there's one person that knows your family, knows your financial situation, knows your investments, your goals, everything, and they're coordinating if needed with a CPA and with an attorney. And in my view, that's what a good advisory relationship looks like.
A good advisory relationship. I couldn't agree more. And you mentioned family. If people do have a business in retirement, you can hire the grandchildren or children to do work, because legitimately, well, you know this from your family business growing up, right? Yeah,
absolutely. Though I'm not sure.
Did you get paid by your parents?
I did, but they just put it in a CD at the bank or something. I never really saw it, but I'm sure they,
I'm sure they did pay me
at some point. I won't bring it up, but I think there's a lot of free labor that went on there.
I think that they did.
So
at the bakery. Boy, do I wish we were there now. Anyway, all right. So speaking of family, I want to mention that what you guys do in the advisory firm is you offer support. It's not just like going to the lawyer, like you said, every farm out each individual task to do with what you want to do with your retirement and what you need to do for your legacy plan or your this plan. But you guys are actually at the other end of the phone for people. And people who become your clients have a direct line to you. If something happens, somebody's injured, you need to make a claim, you need to do this for the insurance, or we're inheriting some money, or, right? I mean, you guys are at the other end of the phone to support your clients. It's not like using a phone bank and talking to someone from a foreign country. You're right here.
Yeah, this is true. I think it's what I think is unique is we're a Nebraska-based company, and so the vast majority of our clients, we've got clients all over the country, but a lot of them are in the Midwest here. And,
of course, yeah.
And we're all from here, and so we're in the community, and we're all from here, and so I think that really, we have Midwest values, I guess what I would say. But the big thing is that for a lot of folks, there's no guesswork. I meet with folks all the time who wonder about, well, my attorney said this, but he wasn't thinking about the tax consequences of this decision, for example, or my CPA said this, but it doesn't really consider my taxes 5, 10, 15, 20 years from now. And attorneys and CPAs are great, so I'm not trying to be negative in any way. No. Everyone's got kind of a wheelhouse of what they look at. But what's nice is that when there's someone that's able to coordinate really across all of those areas and coordinate with a CPA, coordinate with an attorney, and then for any financial question, whether it's, hey, I'm inheriting some money, or hey, I need to buy a car, and what's the best place for me to get funds for that? What's, if I take it from my IRA, what's the tax consequence? Or what if I took it from a joint account or an individual account or a Roth IRA? What's the best solution here for me? That's something where we just take the guesswork out of every financial decision for people, and it's really something where you've got really a co-pilot that's able to help you with every decision and show you the math and the data behind it, but also not just the math. There's an art and a science to everything. The science is sort of the math, what's mathematically perfect, but also what works for you as an individual, and that's that human element and the art side of it.
The art of it.
Yeah, absolutely. And so that's something where I think, what's really rewarding for me and as advisor is really to be able to do that and to step in and to understand the person and not just the math for the decision, and really balance the two.
That's beautiful. 866-295-5146. You can call Stonebridge yourself, 866-295-5146.
The work never seems to end until the day it finally does. After nearly a lifetime on the job, you should be rewarded for all the time you spent working. Whether that's crossing off items on your bucket list, learning a new passion, or rekindling the love of an old one. After all, life isn't over when you stop working. It's the start of an all-new chapter, the one where you're the writer and you get to choose how your story will go. A way to achieve that is by having a clear financial plan to sustain your golden years. The biggest fear most retirees have is if they'll have enough money to maintain the lifestyle they've always enjoyed. Having a plan to help protect you against the curveballs life often throws will help to maintain your lifestyle. Call today to get your free written financial plan so you may live every day to the fullest and enjoy the retirement of your dreams.
We're looking at the Retirement Compass for you. The show is the Retirement Compass radio show with Stonebridge Wealth Systems. Available, at the Kearney office, Grand Island office, Lincoln, Omaha, all the way across the state and into northern Kansas. Well, you guys have clients all the way across the United States, don't you?
We do, yeah. It's cool, but a lot of our clients are based in the Midwest.
Yes. Yeah. I have Eli Mardock. We were going to talk to our ag clients here. You had a subject matter. Are we going to talk about the big beautiful bill, or
a little bit? Yeah. So there's an aspect of that law which passed last July.
Right.
So it's a new farmland sale installment option. So if you've been thinking about selling ground to the next generation, it's a tax rule that I think would be valuable for a lot of folks to know about. It lets you spread the capital gains tax over 4 years instead of paying it all at once. But there's some strings attached. So we'll kind of get into that. So last year, July, so that One Big Beautiful Bill Act included a provision that, at least in my experience, a lot of farm families aren't aware of. And it's designed specifically for farmland sales. And essentially, if you sell farmland to someone who's actually going to farm it, you might be able to pay the capital gains tax in 4 annual installments instead of that one lump sum. Oh. And so that's a really big cash flow change for folks that are trying to move land without a big tax hit in a single year, right? And so, quick example, let's say that you bought ground 30 years ago and you're paying $500 an acre, and now it's worth $4,000 an acre.
Right.
So that's $3,500 per acre in gain. So if you sell 500 acres, you're looking at $1.75 million in capital gains there. At 20% federal tax plus the 3.8% net investment income tax plus Nebraska state tax, you're writing a check for $400,000 or more, and it's all due in the year of sale.
Oh, golly.
And so I think for most farm families, that's a deal breaker, right? So that's just a lot. And it's why so many people choose to hold land really until death just so they get that stepped up basis. And so the big change here is with this law, if you meet certain conditions here, and definitely talk to a CPA about this, or talk to if you're someone that works with us, or you want our financial planning take on this, encourage you to give us a call. But you can elect to pay that tax over 4 years now instead of all at once. And so the first payment, it's 1/4 of the tax, is due with your return on the year of sale, and then the remaining 3/4 are due annually over the next 3 years. So the big difference in that example that I gave is that instead of $400,000 due in 1 year, you're paying $100,000 a year for 4 years. It's the same total tax, but the cash flow is completely different here.
That is a nice change. This would be a relief for so many people. That must be why they just wait, most people, because they don't want to pay this.
Absolutely. Yeah. And you know, it's not available for every sale. So I want to say that. There's 3 requirements. One, the buyer has to be actively engaged in farming.
Okay.
That's important. 2, the land has to be restricted to agricultural use for 10 years after the sale. It's legally enforceable. So it's not just a handshake there.
Right.
And then 3rd, for substantially all the 10 years before the sale, the land had to be used for farming. So that's really important here. But
there's a big buffer on that. And in other words, you can't do that and then put condos up.
Exactly. Yeah, exactly. So it's built for, in a lot of ways, who this applies to, it's for intergenerational transfers. So if you're a parent selling to a child, or an uncle selling to a nephew, or you're a retiring farmer selling to a beginning farmer, this is a great tool to be aware of and to take advantage of.
You can call the fellas at Stonebridge. Jeff Gove works with a lot of our ag clients, but any of the wonderful advisors can help you and direct you, because they do work as a team, especially on complex, family issues, whatever, you know what I'm saying. 866-295-5146, 866-295-5146. Call Stonebridge Wealth Systems.
Did you ever think your retirement would be shared with our government? It's true. Your traditional 401k, IRA, pension, or similar retirement accounts are like a partnership with the IRS. Simply put, they want their tax dollars, and you have them. With our latest tax calculator, you can plug in your own numbers while sitting at home. To find out what your future tax liability could be, scan the QR code or go to stonebridgetaxbill.com.
On YouTube now, Stonebridge Wealth Systems on YouTube. You can get all of the great Stonebridge content right there on YouTube if you'd like to. The radio show, the TV show, it's all contact information. There's a QR code so that you can get in touch. Stonebridge tax bill is linked there, all the fun things. 866-295-5146. Otherwise, if you're ready to jump in and get yourself a visit or a meeting with one of the professionals, Stonebridge Wealth Systems, 866-295-5146. Eli Mardock, what is to do with the federal employee who has $400,000 split between, let's say, a Roth TSP and a traditional? Which do they draw from first, do you think?
Yeah, that's not necessarily a simple question. So it all comes down to withdrawal sequencing and also managing your bracket. So I'm a big believer in micromanaging your withdrawals here. So it's not necessarily a pick one issue here. So traditional withdrawals, if we think about anything in that tax deferred bucket, we always talk about tax buckets. There's taxable, which is essentially you've paid tax on that money and you pay tax on the gain. That's anything in your bank account or an individual brokerage. Your tax deferred dollars, which would be a traditional TSP or an IRA or a 403B or 457, you name it, but they're 401k, same sort of thing, all tax deferred. And then your tax exempt bucket, which would be that Roth bucket here. So any withdrawals, traditional withdrawals, essentially from that traditional or tax deferred bucket, can create taxable income. So it's going to be taxed just like you were earning that money because you haven't paid tax on it yet. That was all pre-tax money.
Right.
So the issue there, depending on your age, is one, not only could it increase your tax bracket or bump you into another bracket, but it can, like we mentioned, increase your future Medicare costs with that 2-year look back here. Roth withdrawals, on the other hand, do protect your bracket, but again, they're very valuable. That's all money that grows in a tax-exempt way. So it can be not exactly the right funds to burn off early in retirement. It's also, those are great legacy funds. Your traditional accounts would be fully taxable to your beneficiary. The Roth accounts are not. So for a lot of clients, if they're inclined to care about legacy and leaving tax-free dollars to kids, they might not want to burn through Roth dollars. So the issue here would be designing a withdrawal blend between the two that covers some spending needs but manages taxes. So it could be a certain portion from your from your IRA, enough that we're not pushing you into another bracket or creating IRMAA threshold issues. And then a little bit from the Roth as well. Or maybe if we throw in that other tax bucket, the taxable bucket, that's taxable money. But again, there's different strategies we can use there, like tax loss harvesting, or potentially even just any money taken from that bucket is taxed at the capital gains and dividends bracket, which is a little better than that middle bucket, the tax deferred bucket, which is taxed as ordinary income. So again, there's a lot to consider there, but that's something where the math is very clear. And what we use is called a tax map. And we can sort of create a tax GPS for someone's situation and show them where exactly they fall with their current plan in terms of taxation. And then as we punch in a withdrawal and we can use different sources, we can show exactly where that little dot would move around and what the tax impact would be. And so it really allows us to make informed decisions on, well, what's our best withdrawal sequence here? Even if that's a long-term plan for how do we take out income on a monthly level over time, or if it's hey, I need a one-time withdrawal here, what's my best combination of funds to do that?
Best combination. That I think that is the key for this person. Is it smart to convert some of this over to non-TSP? Is that the right word?
Yeah. So oftentimes what people will choose to do, and this kind of comes down to the two phases of really financial planning. You've got accumulation phase, which is a lot of us spend most of our lives in that. We're working for 35 years and we're focused on how much can I put away, what's my rate of return, how is it going to compound, and it's focused on accumulation. It's wealth building. In retirement, it's a little bit different. It's about distribution. And so we're taking what we've saved and how do I distribute that to myself in a way that's tax efficient? Accounts like a TSP or a 401k are excellent while you're in that accumulation phase because they're oftentimes low fee and you're able to just kind of put money away and maybe you're getting a match or anything like that. And that can make it a great choice here. But you've got limited options within a plan like that. Oftentimes with a 401k or if you've been in the military or worked for the government, the TSP,
right.
You've got a few different fund options to choose from. But oftentimes there's not a lot. You've got maybe target date funds, target retirement date funds, or maybe you've got certain funds. And most 401ks and the TSP as well, you might have 15 to 20 different options. That's a extremely small portion of the full universe of investment options you would have otherwise. If you were to roll that account over, this is what a lot of retirees choose to do, roll that over to an IRA. And from the IRA, especially if you have traditional funds, that's where you're able to implement Roth conversions. And that's simply and if you're not familiar with Roth conversions, that's simply just in a very measured way, a very mathematically precise way, moving a little bit from your tax-deferred accounts. And it could be all at once if you wanted. Everyone's situation is a little bit different, but for most people, we're using or spreading out those conversions over many years, moving a little bit from the tax-deferred over to that tax-free bucket.
Right.
That's allowing us to reduce our required minimum distributions later, potentially reduce Medicare costs later,
yes.
and creating tax-free inheritance for our beneficiaries and loved ones.
Yes, and Yahoo! I want to say to that.
All good things. Yeah.
All good things. You can call and discuss this very subject with Stonebridge, 866-295-5146, 866-295-5146. Where do you live? Lincoln, Omaha, Grand Island, Kearney? Offices all over, so don't be shy about using the same centralized number we have rigged up just for the radio show because we do put this on multiple radio stations across the Midwest. So 866-295-5146. All right, how about a retiree who wants to use a CD but really doesn't understand how it works? A QCD, I beg your pardon.
Sure.
QCD, yeah. How does it work?
A QCD, so it's a great tool that a lot of folks just don't realize it even exists. I can't tell you how many times I meet with someone and we talk about charitable distributions, and they say, "Oh, well, yeah, I give $400 to my church every month," and it comes directly from their checking
account.
Yeah, and so if that's you, this would directly apply to you, or maybe it's a different cause that you really care about. But essentially, if you've got funds and you're starting to, maybe you're starting to think about required minimum distributions, or if you are 70 and a half, this is when it can apply to you. But if you're over 70 and a half, a QCD, or a qualified charitable distribution, is essentially it's a direct IRA to charity transfer. And so when you make a withdrawal from an IRA or even a 401k or anything like that, as soon as it hits your bank account, that becomes a taxable event. But if it's coming directly from your IRA or the 401k and going to that charity, it's never triggering that taxable event. But as you, especially as your RMDs kick in, you can actually satisfy your RMDs through a QCD or qualified charitable distribution. So rather than having the money come out and increase your income, you can essentially send it directly to a charity. Now you can, for 2026, the thresholds change slightly, a little bit every year, but it's $111,000 per person, indexed for inflation. And that's a very clean way to avoid, if you do have RMDs that are coming in and you know, if you don't need that income and you are charitably inclined, it's a great way that you can give more to your community and to causes you care about, and also get a nice tax benefit from it.
Mm-hmm. So don't just write the check from your checking account. Call Stonebridge first, 866-295-5146, 866-295-5146. Because, boy, is that a great advantage.
It's awesome. I've got some clients that are great folks, and with the hurricanes and everything that have been happening, especially with Jamaica, they've used their RMDs to donate for that cause, and it's just great to see that. It's a great use of that money.
Mm-hmm. That's super generous. If somebody writes a check for $400 every month to their church, that could be a humongo benefit to their taxes.
Absolutely, yeah. I've got
so
another
generous
client that I think they're doing at least $600 a month to their church, and it's all QCDs, and so it's a great way to give what you want to give, to the causes you care about, whether it's your church or other nonprofits, and again, just have a nice benefit for you in terms of your taxes.
Mm-hmm. Beautiful, absolutely beautiful.
Kind of a win for everybody.
We've covered a lot of territory with our scenarios, I think.
We have, yeah.
Do you want to give a last pitch here before we leave this whole darn show, and whatever's on your heart you want to tell the listener about? Or
yeah, I think the big thing that I would just say is that, and I think this applies for all the advisors at Stonebridge, is that our first goal when we sit down with anyone is not to talk about investments or products or anything like that. It's really to get understanding first. And it's about clarity. I'm a big believer that, when I sit down with anyone, and whether that's clients or anyone that's coming into our office with some questions, any of the families that I sit down with, if you have clarity, you really can see the way forward. And the path forward becomes very, very clear. And so really the goal is to, in terms of finances, I think everyone I meet with has, issues that there's confusion about, or, that they just don't have clarity on, whether it's your income or how you pay for long-term care, or how money passes to the next generation in a tax-free way, or how you can optimize your investments to, to make them last throughout retirement and not run out of money. Really the thing here that I think the value of sitting down with someone that's connecting the dots on all these issues, where mainly, I think for a lot of people, it's disjointed, and it's, everyone's looking at them sort of as separate issues and not all together.
Right.
That's really what we do, and I'd say it's really rewarding to do that and to give folks clarity. And that's whether they work with us or not. But if it's clarity on any of these issues is something where the listeners, there's a lack of clarity in any of the subjects that we discussed or any other financial subjects, we'd love the opportunity to provide you with that clarity, and you can make the decision for yourself on the best action to take in terms of a way forward.
866-295-5146, 866-295-5146. Retirement Compass Radio Show returning next week.